2026. And if you've glanced at the markets today, specifically the commodities ticker, you probably did a double take. I know I did. I actually refreshed my screen thinking it was some kind of data glitch.
It definitely looks like a glitch if your mental model is from 5 years ago or even 2.
Exactly, because spot gold, I mean, that heavy, boring rock that's supposed to just sit in a vault somewhere is acting like a tech stock on launch day. As of this morning, it pushed aggressively toward that $5,000 mark. I saw a high of $4,880 an ounce.
It's a staggering number. And I think before we even get into the why, we just have to acknowledge the context. A few years ago, $2,500 was a moonshot prediction. People laughed at $3,000.
Oh, absolutely.
But after that, just historic 60% gain in 2025, the momentum is just, it's not stopping.
And that is exactly what this deep dive is about. We've got a whole stack of research here. LBMA surveys, notes from Goldman Sachs, frankly, some wild analyst predictions. And we really need to unpack why this is happening and look at these targets, $7,000, even $10,000, and figure out, is this a huge bubble about to pop, or is this, the new normal?
That's the multi-trillion-dollar question, isn't it? Is this just irrational exuberance, or is the market pricing in a fundamental break in how the world operates?
So let's start with the why now, because gold jumped, almost 2.5% this morning? Something had to trigger that. And reading the headlines, it feels a little niche. We're talking about Greenland.
It does sound niche, yeah. If you weren't paying super close attention, you had missed it. But yes, the specific catalyst for this week's surge was news about White House tariff threats against Greenland.
Greenland. I mean, usually when we talk trade wars, it's China, the EU, massive economies. Why does a tariff threat against an island of 56,000 people send the entire global gold market into a panic?
It's a great question. And it really speaks to the fragility of the market psyche right now. Look, the actual volume of trade with Greenland, it's tiny, negligible for the U.S. economy. But markets run on signals, not just volume.
Okay.
And this move sent a very specific and very alarming signal. It said, the trade war isn't over. It's getting erratic. It's expanding into places you'd never expect.
So it's the unpredictability. It's this feeling that if they're picking fights over Greenland, then no trade relationship on the planet is safe.
Precisely. It just reignited all those old fears of a full-blown global trade war. Investors see that and they think, if the rules can change for Greenland overnight, they can change for anyone. And you pair that with the other things we're seeing, like the recent U.S. actions in Venezuela.
Right.
And you've got this global map just lighting up with friction points.
So you have tension in the Arctic, tension in South America, and the reaction isn't to buy stocks, it's to run.
It's the classic flight to safety. But I think we need to be really specific about what safety means here, because people throw that term around. In our financial system, almost every asset you own, it's just someone else's liability.
Break that down a little.
Sure. A bond is the government's promise to pay you back. A bank deposit is an IOU from your bank. A stock is a claim on a company's future profits. It all relies on the system working, on promises being kept.
And that's counterparty risk.
Yeah.
The risk the other side won't pay out.
Exactly. But gold has no counterparty risk. It's not an IOU from anyone. It's just an asset. It doesn't depend on a government promise or a CEO's quarterly report. So when investors see this kind of erratic behavior, they scramble for the one thing that can't default.
That's a really crucial distinction. It's not just about making money. It's about holding something real, something outside that web of promises.
Yes. And that mood is what's behind this price. It's a hunt for a safe harbor in a really big storm.
Okay, so the world is messy. People are buying insurance. I get that.
Yeah.
But let's talk about the price of that insurance. $5,000 an ounce. That feels like such a huge psychological barrier. But looking at this London Bullion Market Association survey, the LBMA, it seems like the experts have already accepted it.
They have, and the speed of that acceptance is what's so incredible. The consensus has just shifted so fast. The LBMA survey shows analysts now widely expect gold to break $5,000 and stay there this year. It's almost, the baseline assumption now.
So $5,000 is the new floor. But okay, what really jumped out at me in these notes were the outliers. The people looking at 5,000 and saying, that's cute. Some of these forecasts, they just sound like typos.
They really do. The goalposts have moved so far, so fast. We're not just talking about $5,000 anymore. The serious conversation among the bulls has moved to $6,000, $7,000, and even higher.
Let's name some names. Julia Du at ICBC Standard Bank. She's got a target of $7,150. That is aggressive.
It is. And her thesis is mostly about currency devaluation. But if you want the most intellectually interesting argument, you have to look at Ed Yardeni.
Yardeni's a legend. He's calling this the roaring 2020s. But his logic feels backwards to me. I always think, economy's great, you buy stocks. Economy's terrible, you buy gold.
That's the traditional thinking, yes. Risk on versus risk off. Yardeni is basically saying, throw that out. He thinks we're entering a phase where both go up. He sees the S&P 500 hitting 10,000 by the end of the decade. And he says if stocks hit 10,000, gold also hits $10,000.
Wait, hold on. So stocks double and gold doubles. How does that work? Is it just everything's more expensive?
It's about portfolio balancing. Think like a huge pension fund. Yardeni's point is, if your stock portfolio suddenly doubles in value, your whole risk profile is out of whack. You're way overexposed to stocks. So to rebalance, to get back to your target allocation, you have to buy more of your insurance asset. You have to buy more gold.
So the stock market's own success forces big money to buy gold.
It drags gold up with it, exactly, to maintain the balance. It's a rebalancing act on a massive scale.
That sounds like a have your cake and eat it too market. But there's a dark side to that, isn't there? If stocks, commodities, real estate, everything is soaring in price, isn't that just another way of saying the dollar is collapsing?
That is the uncomfortable truth behind it, yes. And everything rally is usually a signal of currency debasement. So the number in your portfolio gets bigger, but so does the number on your grocery bill.
And then there's Jim Rickards. He's not even waiting for the end of the decade. He thinks $10,000 could happen this year, 2026.
Rickards has always been a bull, but his timeline is just accelerating. He sees the geopolitical fractures we talked about, the trade wars, the sanctions. He sees them breaking the system much faster than anyone thinks.
Okay, there's one more prediction in here I have to ask about. It feels like science fiction. Saxo Bank. They do these outrageous predictions, and this one involves quantum computing.
Right. This is a fascinating tail risk idea. So Saxo imagines a world where there's a sudden, massive breakthrough in quantum computing.
Which sounds like a good thing. Faster computers, medical stuff.
For science, yes.
Yeah.
For finance, maybe a catastrophe. The fear is that a powerful quantum computer could break most modern encryption.
You mean like the encryption that protects my bank account?
Exactly that. The encryption for bank wires, SWIFT, even crypto. If that gets broken, the entire digital financial system is suddenly insecure. You can't trust that a number on a screen is real anymore.
Oh, wow. I never even thought of that. So if you can't trust digital...
You run back to the analog. In a world where digital wealth is vulnerable, money would pour into the ultimate physical analog asset, gold. Saxo sees that panic driving the price to $10,000 almost overnight.
That's terrifying.
Yeah.
But I guess it's a powerful argument for owning something you can actually hold in your hand. So it doesn't matter if it's a tech boom like Yardeni says or a tech disaster like Saxo says. The road seems to lead to 5 figures.
The narratives are different, but the destination seems to be the same.
But I want to push back here for a second, because whenever I see a chart go vertical like this, and gold's chart is absolutely vertical, my first instinct is bubble. Is this just hype? Are we the fools buying at the absolute top?
That is the most important question an investor can ask, and it's where the experts in our sources are pushing back really hard against that bubble idea. Look at Nikki Shields. She's head of metal strategy at MKS PMP. She is very, very firm on this.
So what's her argument? How is this different from, say, a meme stock mania?
She draws a line between a speculative peak and a structural trend. A speculative peak is just FOMO, people buying because the price is going up. It's pure psychology. A structural trend is when the actual underlying reasons for demand have permanently changed.
Structural sounds.
Yeah.
Permanent.
It implies these drivers aren't just going to disappear next week. Think about what we've been talking about. Geopolitics, trade protectionism, the use of the dollar as a weapon. Shields argues these aren't temporary glitches. This is a new era where securing resources is the top priority for every nation.
So because the world is structurally more dangerous, the price of safety is structurally higher.
That's it, in a nutshell. She sees gold hitting $5,400 this year, but she's explicit. This is not a blow-off top. This is a fundamental repricing of risk.
And it seems like the big institutional money agrees with her. I was looking at this Goldman Sachs survey data. Usually when something's at an all-time high, you see the bears come out, right? People start shorting it.
You would, yes. You'd expect the market to look overbought. But that group is tiny right now. The Goldman survey showed that even at these record prices, the bullish sentiment is just dominant.
What were the actual numbers on that?
42% of institutional investors see a rebound to between $5,000 and $6,000. And a big chunk sees it going even higher.
And the bears, the people betting on a crash.
Single digits. Almost nobody. And that tells you something really important. The smart money doesn't see this as a speculative bubble. They see it as a necessary part of their portfolio. They're not buying it to flip next week, they're buying it to hold.
That's a huge takeaway. This isn't about getting rich quick. It's about the biggest players in the world not feeling safe holding just paper assets anymore.
It's a defensive move that looks like an offensive rally from the outside.
So speaking of the big players, let's talk about who is actually doing the buying now. Because for the last couple of years, the whole story was central banks, right? China, Poland, Singapore. Is that still what's driving this?
That's actually shifting, and it's probably the most important evolution in this whole story. We have some analysis here from Dan Stroyven at Goldman Sachs, and he points to a really clear changing of the guard.
So the central banks are done, they're selling.
No, not selling, they're still buying. But they are not the primary engine for this leg of the rally. Stroyven kind of breaks it down by era. 2023, 2024, that was the central bank era. They were buying to de-dollarize their reserves, to protect themselves from sanctions.
Right. Sovereign nations buying. Slow strategic money.
Exactly. But 2025 into 2026, this is being driven by the private sector.
So we're talking Wall Street.
We're talking private wealth firms, asset managers, hedge funds, pension funds. And the way they buy is different, too. They're not flying pallets of gold bars into a vault. They are pouring money into ETFs.
Right, the exchange-traded funds. It's just like buying a stock, but it tracks gold.
It's the easiest on-ramp for Western capital. You just click buy in your brokerage account.
And those flows are big.
They're enormous. Stroyven calls gold the highest conviction trade on the street right now.
Okay, but why does that shift matter? Who cares if it's a central banker in Beijing or a hedge fund manager in New York?
Because private money moves faster, and there is so much more of it in the West. When a central bank buys, they move slow. But when Western capital decides something is a trend, it floods in. It signals that de-dollarization isn't just a political strategy for countries angry at the U.S. anymore. It's now a standard, prudent financial strategy for a money manager in London or Hong Kong.
That is a massive shift. So the idea has gone mainstream. It's not just a geopolitical thing for nations anymore. It's a normal thing for your pension fund to do.
Yes. And that makes the rally's foundation so much broader. It's not just one type of buyer. You have the floor being set by the central banks, and now you have this explosive upside being driven by private capital. You've got two huge engines firing at once.
Okay, let's try to pull this all together. We've gone from Greenland tariffs to quantum computing threats. What's the bottom line here?
I think if we summarize the takeaways from our sources, the picture is actually pretty clear. Gold is near $5,000, not because of a mania, but because of real, tangible fear about trade and geopolitics.
Right. The world feels unstable, so the price of stability goes up.
And those wild predictions, the $7,000 or $10,000 calls, they're not random. They're based on these structural arguments, whether it's the Roaring '20s Rebalancing Act or a total loss of faith in digital assets.
And crucially, the baton has been passed. This rally has deep, deep pockets now that the private sector has jumped in.
Exactly. Gold is just doing what it's done for 5,000 years. It's acting as the ultimate hedge when the system feels shaky, and the world is voting with its wallet.
You know, we started by asking if this was a bubble or a new normal. And I think the answer is it's a new normal because the world itself is in a bubble of uncertainty.
That's a good way to put it. We're pricing in the cost of chaos.
Before we wrap up, I want to leave everyone listening with one final thought, and it goes back to Ed Yardeni.
The $10,000 stocks and $10,000 gold idea.
Exactly. I want you to really think about that scenario for a minute. If the stock market and the gold market both race to 10,000 at the same time, what does that actually tell you about the value of the dollar in your pocket?
It's the denominator problem.
Right. If it takes twice as many dollars to buy a share of a company and twice as many dollars to buy an ounce of metal, are the assets really worth more? Or is the dollar just worth a whole lot less?
That is the really uncomfortable question under all of these charts. And if the answer is the latter, then $5,000 gold might actually be cheap.
Something to chew on. A huge thank you for breaking down this gold rush for us. And thank you, the listener, for diving deep. We will see you next time.
Goodbye, everyone.
Stay curious.